military exercise. So I agree that there are two kind of trains of thought in terms of why inflation is so high, but I believe it's a combination of both of them.
All right, Gary, we're going to circle back to Ukraine and Russia in just a bit. But first, I want to talk about how gold and perhaps other assets are going to react to inflation, this sustained level of inflation that you're talking to me about. I have here two charts, the first showing headline inflation versus gold. Now, this chart is significant in a number of ways. First, it shows that gold, first of all, has not kept pace with inflation over the last year. As you can see in the blue line, headline CPI is now at 7.5%. If you look at the left side of the y-axis. And on the right side, the orange line shows the GLD ETF. Again, it's only growing in the single digits, not yet at 10%. So compared to where it was last year, where it was growing on an annualized basis of over 30%, gold seems to be slowing down relative to the pace of inflation. So that's number one. I like to see where inflation is going to lead gold, or perhaps the other way around going forward. Now, the other chart I have for you is the same thing, except we're showing the S&P 500 now. So headline inflation versus stocks. Similar story here, actually. Now, stocks have been going up steadily, but on an annualized percentage change basis, stocks have not kept pace with inflation. As you can see, the orange line has been trending downwards, while the blue lines, which signifies or which shows inflation, rather, that line has been steadily trending upwards nonstop since basically 2 years ago. So, are assets able to keep pace with inflation right now? Any asset, stocks, inflation, even cryptocurrencies, stocks, gold, I meant cryptocurrencies, none of these things seem to be keeping pace with inflation right now.
Well, I'll address both the U.S. equities markets as well as gold. I'll stay away from cryptos as I'm not an expert.
Sure.
But I think the wild card that we're seeing is the fact that it's acknowledged that the Federal Reserve is going to go to interest rate normalization. It's been kept between, in essence, at zero for so many years that even these small hikes of a quarter, maybe as much as a full percent, are slowly being factored into pricing in U.S. equities. Equities are up today, but they have been under pressure for a couple of weeks. And I believe that the pressure they were under was a direct result of the future actions of the Federal Reserve. So they're pricing in a more aggressive Fed that will raise rates. I think it was Bullard from the St. Louis Bank that came out and said that he believes we should see a full percentage rate hike by July of this year, a very hawkish and aggressive stance, regardless of how quickly they raise it. Because remember, initially, we were supposed to get a series of 3 rate hikes of 0.25%, which would take the Fed's fund rate from 0 to 0.25 basis point or 0.25% up to 1%. And now the hawkish arm of the Federal Reserve is saying, no, we want to raise it by 1%, taking Fed funds rate to, in essence, 1.25% in the next few months. So as this is a dynamic change in the Federal Reserve, we are seeing that kind of a knee-jerk reaction to the acknowledgement that rates are no longer going to be at zero. There is not going to be free money, as there has been for these corporations that did exceedingly well during the recession through 2020, to a great degree, 2019, the second half. Equities were just ascending to unreal valuations, and that was based upon the fact that they could expand and borrow at zero cost. So that's why I think we see that kind of a loose correlation on the chart that you showed with stocks. Now, as far as gold goes, I think that gold is a hedge against inflation, but it greatly lags behind real-time data. And so while we've seen it pick up, I believe that if, in fact, the levels of inflation have not peaked and that it will be a multi-year process to bring it down, then what we will see is gold at some point start to play catch up to
that.
Right. Well, let me give this a setup. What we're looking at is a long-term chart that goes back into 2019, and it really shows the rise up to the peak at 2088. As that occurred, what you can see, I've got three moving averages. The one on top is a dashed green line that represents the 50-day, a blue dashed line which represents the 200-day, and then the red line represents, the blue line is a 100 and the red line is a 200. And you can see you've got the 50, 100, and 200. That is what we call full bullish alignment. And then as the market came down, you see where the 50 goes in and it crosses below the 100, then the 200. And you've had kind of almost a movement where they continually cross, which is why, I'll blow this up now, you can see right now in recent history over the last, say, week, we have had a golden cross, but if you look back, 2.5, 3 weeks ago, we had a death cross with the 50-day moving below the 200-day. My point of this is that what we need to inevitably see to believe that we're going to have a substantial move in gold long term, and I believe that would be based on them not being able to curtail the current level of inflation quickly, is you need to see it back in bullish alignment. If this stays the way it is, we still need to see this dashed blue line on the bottom move above the 200, and that would be full bullish alignment, and that would curtail a major move in gold, and I think near the highs of what we saw in August of 2020 when gold hit 2088.
Whoa, okay, hold up. So that's your target, 2088?
I've just put up one of the models that I use, and this is a combination of Elliott wave, and Fibonacci extension. What you can see is this is the high, it's labeled as a 3, and then we had the long correction that lasted until the first part of 2021, taking gold down to 1678. It then rose to 1920. And what we've seen recently, really throughout the second half of last year and into this year, is a narrowing of range in gold. In other words, we've had this series of lower highs and higher lows. And recently, you can really see it in the daily, but recently we broke above that price point. And so what I believe is that if we have this inflation level remain more persistent than believed, I think that we could see gold short term over the next, say, 3 to 6 months go as high as 2015.
Okay.
So certainly
Perfect.
not beating the record, but I believe that we could see substantially higher prices. And I'm leaving out if the geopolitical tensions actually evolve into something major. This is based on levels of inflation at 7%, a 40-year high, and what the Federal Reserve is going to do. Because, of course, when you raise interest rates, it's a push-pull scenario with gold. Gold reacts favorably to inflation and the opposite to higher interest rates. I think we have that opportunity.
I'm guessing you're implying that should war actually take place, gold will go even higher than your $2,000 forecast, right?
That is correct. My long-term forecast, based on the scenario